Welcome to Business Talk with me, Michael Avery, and time to talk about financial regulation. And it often feels like the perfect blend of molasses and bureaucracy in South Africa. It's slow, it's sticky, and frustratingly resistant to change. But fear not, because South Africa's fintech revolution feels like it's at a crossroads as well. On the one side, you've got very agile, innovative startups that are democratizing digital payments and giving small businesses a fighting chance. And on the other hand, you do have the country's big banks who are entrenched and powerful and increasingly protective over the data and the infrastructure that fintechs rely on to operate. But today we've got someone who has spent his career navigating and sometimes bulldozing through these regulatory roadblocks. My guest is Ali Mazanderani, who's executive chairman at Lesaka Technologies, a fintech investor, an entrepreneur, and someone with a resume so packed with qualifications it reads a bit like a university prospectus. He's been at the heart of payments innovation in emerging markets. He's co-founded a pan-European fintech, and he served on the board of companies from Brazil to Singapore. So if there's anyone who can make sense of South Africa's regulatory quagmire and tell us how to fix it, it's Ali. Welcome to Business Talk, Ali. You've, as I said, had a front row seat to this evolution across multiple jurisdictions and markets around the world. So maybe you could just start by giving us a brief overview of how you've witnessed regulation either hindering or facilitating progress.
Well, firstly, thank you very much, Michael. And I do indeed consider myself very fortunate that I've had the ability to operate and be intimate to building multi-billion-dollar disruptive fintechs around the world. I think that, honestly, without the enabling regulatory environment that existed in it is irrelevant as whether it's India or Europe or Brazil. The digitization of those economies would not have happened without acts of omission and acts of commission by the regulators, not just the central bank, but also the antitrust authorities.
Now, you've seen how different regulatory approaches either accelerate or stifle financial innovation, as you say, either via acts of commission or omission. Where does South Africa sit on that spectrum? Are we a fintech-friendly nation, or are we in danger of regulating innovation out of existence?
So, Michael, it's with great regret that I have to say that the regulatory framework in South Africa for digitization is a disaster. And I don't think that word is an exaggeration. I think that the last 20 years, by any sensible metric, it's clear that the country has failed its citizens. The data that the South African Reserve Bank itself uses in its the report that it issued in April of last year is really very, very startling. It's data that suggests that 50% of all adults withdraw pretty much the entirety of the money that comes into their account every month from an ATM. It's data that says that more than 90% of SMEs in the country don't have a point of sale that accepts digital payment. It's data that says that the majority of transactions that happen in the country are still in cash. It has nothing to do with economic development. It's very, very clear that, whether you compare the country's journey to Asian countries or to Latin American countries, or indeed to other African countries, we have not created a successful digitization journey. And I think it is absolutely as a consequence of the regulatory landscape in the country. And it's not because of malicious. I think you have a problem because you have very capable, well-intentioned regulators, but the agenda, in my mind, was hijacked. And it was hijacked by parties who didn't recognize or see the benefit directly clearly to themselves and had an interest in maintaining the status quo. But it's not all doom and gloom. There has been pronouncements that I think have given some hope around how that will evolve. But if you're asking me about the situation today, it's unrecognizable. I was brought up in South Africa. This is this is where my heart is, and the fact that I had to go around the world, to India, to Southeast Asia, to the Middle East, to Latin America, and to Europe, to build multi-billion-dollar businesses, which would have been impossible to have been built in South Africa because of the regulatory environment.
Well, I mean that's the bottom line at the end of the day. Let's talk specifics. Where are the major inefficiencies or the roadblocks in South Africa's banking and payments regulations? And more importantly, what's the price tag of these inefficiencies for businesses and for consumers?
So let's start with the price tag. I mean, this is an enormous tax on our society, and because it happens in a very broad-based sense, the extent of it is often underappreciated. It's not just the cost for the pensioner sitting in a rural area who has to get the bus money to go to an ATM, who gets charged the cost of that withdrawal, which is very regressive in terms of because the fact is we have a society that has material crime issues. The cost of cash is not just the printing of that cash; it's also the fact that you need the security apparatus around it. It's the facilitation of ill-gotten gains for the criminals who are often participating in that cash handling process. And then is the cost to the banking ecosystem as a whole, which is honestly, in my view, it's very short-sighted, because one of the main beneficiaries would be the banking ecosystem, because the digitization of an economy results in larger cash deposits. It results in the greater availability of finance for investments for that society. I have no doubt that this is costing the South African economy and probably the exchequer not just billions of dollars or hundreds of billions of rands. It's probably one of the greatest impediments to the economic development that can be relatively easily addressed, because you do have intelligent, well-meaning, capable regulatory apparatus around here, and the problem is, not only is the problem not insurmountable, we've got great examples, great counterfactuals from around the world as to how you address this problem.
So, where let's come back to the beginning of the question. Where are the major inefficiencies that you see that could be addressed, with some regulatory reform? Because we have seen some reform in the system, but clearly not enough.
So you have a structure at the moment in which a large part of the empowerment of the regulatory environment for the payments ecosystem was given to the banks in one way or another through different associations, which form the rule base of how you can engage. I'm going to try and highlight a few areas that are sort of relatively clear. So the one area that's relatively clear is in the payments ecosystem, especially in the card world, there is a market failure in input prices that is well acknowledged. And that's why regulators around the world typically provide a framework for something called interchange, which is the cost of wholesale pricing that a business that contracts with a merchant to accept a digital payment needs to pay. In the South African context, the way that has been framed has been as a cost-plus exercise that the banks are providing for. And if they have an incentive on their issuing base, on their consumer side, because they make that interchange there, they have an incentive to create very, very high interchange. And South Africa's interchange is extremely high relative to the other countries that I've operated in it. It's very difficult for me to understand why it should be higher in South Africa than in Europe, where the cost of cash is obviously far greater here. The cost to the economy is far greater. And, the way that card, especially interchange, when people use a card at point of sale, is determined, has not been addressed in a very, very long time. And there's really not been the right impetus associated with addressing it. So it's not that I believe that there's always, instances where the regulator shouldn't be involved. I actually believe that there's instances of market failure where they proactively should. And this is something that exists around the world. It's been managed in proactive ways by regulators around the world. And it's unclear to me as to why it's taken so long. And it directly impacts the cost of retail prices across the country. because competitive forces at point of sale can never go down further than effectively the input prices that they get.
It sounds like, again, historically, if you look at the banks, they do hold an iron grip on the core platforms that support the ecosystem of payments and financial services. You've got BankServe now, PayShop, you've got DebiCheck with collections, you've got bank statement sharing, which is the Document Exchange Association. So it does look like if we're going to open up to fintechs and innovators, that one needs to, from a regulatory perspective, try and address that market power that seems to, from the outside, be protecting vested interest and existing profit pools.
Yeah, there's two components. So the first one is access. So I mean, there should clearly be equal access to payment infrastructure, but also access whereby the way that the regulatory framework was set up in South Africa requires a non-bank participant to have a bank gatekeeper relationship. There is no chance of creating the right innovative structure, the right incentive for non-bank participants if you are required to go to a bank who may perceive themselves as a competitor in order to create that enabling environment. And that banking pool has actually diminished over time. So the problem has actually got greater. And it's not just on the merchant side, it's also on the issuing side. The way that the regulation set up does not allow a fintech sensibly to instantaneously settle with a merchant. That prohibits the digitization because it's a working capital problem for a merchant. The way that the regulations are set up do not allow for pretty much any of the sort of activities at scale with the right unit economics that facilitated the rise of the fintechs in Europe and Latin America. A Revolut, as an example, could not operate in South Africa as a non-banking party because we don't have an e-money regulatory framework here. It just doesn't exist.
And Revolut, my partner's son has been at Trinity College in Dublin for the last 3 years. It's just such a phenomenal innovation. And I've often thought, well, why don't we see such innovation here? Because we certainly have the entrepreneurs. If you look at the Kalecha Mapais of Yoko, for example, and others, we have seen regulatory reforms in payments, though. And here in South Africa, the Reserve Bank is starting to move in that direction. Is it a case of better late than never, or do we need far bolder reforms to start making a real impact?
It's firstly 2 points. These business models can operate in South Africa, and I'm sure that you will see the equivalencies of a Revolut and the Yokos in South Africa. It's not that they can't operate; it's that they can't achieve the unit economics, the digitization, the scale in the current environment. So, just as a qualification, I'm the chairman of a fintech business. I believe in the fintech opportunity in the South African market in the current regulatory environment. But what I do not believe is that the current regulatory environment provides the right framework either for the country and indeed, ironically, for these participants. In terms of, I think that there are good moves afoot, but the moves don't address all of the issues. They don't address all of the cost issues, all of the routing issues, all of the regulatory umbrellas, because at the heart of the structure that exists is that the way that the payments game works is framed by an association that is run by banks, and I know that there is a desire to evolve that, and I hope it does happen quickly. But I would observe, maybe a few things, which is that 2 arguments are used to restrain the obvious progress, and those arguments have been successful for the last 20 or so years, which is why we are where we are. The first argument that's used is that we should sacrifice basically all the progress, we should incur all the costs on the altar of financial stability. The assertion that in some way, creating a regulatory environment that is conducive for innovation in fintechs impacts risk in the economy, and our financial system is sacred, and we want to ensure the trust and stability there. There is, to my mind, almost no evidence to represent that argument. and it's sort of the last refuge of the incumbent trying to protect a legacy profit pool. And we need to be very aware when that argument is used of asking the question, what is it specifically that is the risk that has been created here? Because it very quickly falls down. Otherwise, the ECB would not be engaging with the regulatory framework that they are. I'm the president of the European Digital Payments Industry Alliance, which represents the independent payment service providers in Europe at Brussels. And I've never had that argument with the ECB, right? I don't know why we should feel that. It's also been the same in Brazil with the central bank there. So that's the first argument we have to be very cautious of. The second argument we have to be very cautious of is there's often an exchequer argument, an argument that the banks provide a very, very relevant profit pool for SARS, and we need to be cognizant of that profit pool and ensuring that the tax net in the country allows us to make the requisite investments. And the very interesting thing from that is that same argument was used in Brazil with PIX, with digital pay, the digitization of the economy there. And the truth was that actually, the banking environment can benefit hugely from this digitization because of what the consequences on the deposit base, and because cash is a very inefficient medium of exchange. But what ends up happening is vested interest within specific arenas fights the fight. And as I say, we don't have to imagine it. We can look at what happened in India. We can look at what happened in Brazil. We can look at what happened in Europe, and we can just follow that trajectory. It's really not that complex.
But expand on that, Ali, because I think some viewing this might not be aware. When we had RPP rolled out and then PayShop launched, everyone thought, well, this is our moment. But it then quickly fell flat because it's not free like it is in markets like Brazil and India and elsewhere where you've seen huge adoption. What was the impact in those markets when you started to see real commitment?
I'm not sure that the problem is the cost, if you want my honest perspective. I think that, the regulator in South Africa is trying to make energy. So there are things that require direct regulatory intervention, and those are market failures. And then there's things that require the enabling environment for entrepreneurial spirits like the ones you mentioned to try and take advantage of it. And sometimes what regulators do is they don't intervene where they need to because there's a market failure. Like, for example, a bank on its own acquiring, having lower cost routing for its own issued card base than for third parties. They should offer that to the whole market. Why not? That's a bundling exercise. That's what would be required in other jurisdictions, or the interchange example I mentioned. And then there's other things where the digitization journey of the economy, I don't think requires the SARB to, for example, own BankServe and propagate PayShop. I think it requires equal access and a level playing field in order for that to exist. Because the problem in South Africa is very easy to understand. It's not a chicken and egg problem. Pretty much, more than 80% of adults in the country have a bank account. They have a card. The problem is they're going to an ATM and withdrawing cash. That's the fundamental problem. So we know what the problem is. It's that there's not the enabling environment at the point of sale. And we don't need to, having an account-to-account option, I think, is a good option. It's a low-cost option. I think, these things should be at the lowest possible cost. But the problem is, consumers will behave the way that consumers will behave. You need to drive the point-of-sale infrastructure in the country in order to enable that reality to exist. Because the people who the account-to-account product is really appealing to today are already people who are able to pay electronically. And it's not disintermediating the cash environment. It's just disintermediating aspects of card, which is not going to fundamentally move the needle in this society. What is going to move the needle in society is having the investment case to build the point-of-sale infrastructure, and having the investment case to build the point-of-sale infrastructure requires the ability for non-banks to not have gatekeeping relationships by banks and not to have artificial high cost of wholesale pricing. That's really it. It's very simple.
Now, you attended the launch of the Association of South African Payment Providers, ASAP, with a double P. Great acronym that, given the urgency with which we need to address these issues. As you say, we've been talking about it for almost 20 years now. That was last month. What's the mission, and how do you see it shaking up the payments landscape so that we can finally see the benefits that we've just been discussing?
I think independent players have to have a voice, and in the society, in South Africa as a whole, the regulators have really only heard one voice over the last 20 years, and that has been the voice of the incumbent banks. And I think that one of the things that ASAP hopefully should provide is that voice, that there is another reality that can be articulated. I think ASAP is a wonderful construct. I think it's bringing together like-minded people who are really there to drive the societal benefit. I think that the principal objective should always be around that, and its purpose has been clearly articulated. I think it's three things. The first thing is, I think that it strives to create equal access to help with the innovation, and as a consequence of that, the digitization of our society. It strives to reduce the wholesale cost of payments, whether that be through account-to-account methods like PayShap, or through intervention in things like the interchange, or through the cost of settlement, because you face an unfair playing field today in the country. And it strives to have transparency of information and portability of information, so that customers have the freedom to move. You mentioned some of the open banking challenges that exist, and I think that those three missions are all ones that benefit everybody if addressed. And so I hope it's not just the ASAP participants who are excited by it, but I hope also the enlightened parties within the banking ecosystem are excited by it, because it's not just about banks versus non-banks. To be honest, that's an artificial distinction. That's just a question of what regulatory license you hold. It's really about those who are willing to move the agenda forward and not protect existing profit pools and sacrifice the evolution of society on the altar of that, versus those who are thinking in the short term about the structure of the market.
Well, I certainly hope, after years of the sort of cat and mouse game with some of these straw man arguments that have been put forward, that we are going to start seeing some real change. If you were to look ahead, and I know Ray Dalio famously said those who live by crystal balls end up eating shattered glass, so it's always a fraught exercise. But what would be your hopes or fears for the future of payments in South Africa? And if you had the power to rewrite the regulatory playbook tomorrow, what would be the first thing that you'd change?
So the first thing I think is, I am really glad, happy, grateful for the pronouncements that have come out of the central bank, out of the SARB in the recent past. I think they've all been in the right direction. So I'm very, very supportive of that. I think the things that I would like to see is, the first thing is, there are vested interests that articulate a counter argument, and so I want to ensure that the voice of that really supports that regulatory agenda and evolution is heard. I'd like to see really, those ASAP missions being diligently addressed, because the devil's in the detail, and we have to be very vigilant to ensure that we achieve the change that the country deserves. So the first one is, I would like to see non-banks being able to participate without gatekeeper relationship for banks, on both the issuing and the acquiring side, on both the consumer holding a store of value and the merchant acceptance side of the ecosystem, as exists in other markets, in order to provide that choice, because I don't think that it should be a trade-off between security and otherwise. And I think that the pronouncements appear to be going in that direction, and I hope to see more about that soon. And I also really hope that regulators, both the central bank and also other authorities, look closely at where there is a market failure in input prices, to try and also use the example of other jurisdictions where the market failure in input prices to address that, because the cheapest that you can offer to the customer is going to be your input prices, and it is very artificially high in the country. And I feel like it's the most direct tax. It's a direct tax at all retail spend, if you are accepting a point of sale. And if you're not accepting a point of sale, it's the reason why you don't have that evolution, So I hope that both of those things change in the near term.
Well, there you have it. Regulation. It's one of those, the necessary evil that can either unlock innovation or keep it locked in a filing cabinet marked pending approval. Ali Mazanderani, thank you very much for sharing a bit more into that regulatory minefield in payments with us today. Let's hope that South Africa's regulators are listening, because if the cost of inaction is high, I think the cost, as you said, of bad regulation is even higher for the broader economy. Especially at a time when we need to be enabling a greater digital adoption away from cash and supporting the growth of SMEs. And this is an absolute no-brainer, in my opinion. Well, that's it for this episode of Business Talk. Keep innovating, keep questioning, and as always, I think follow the money. See you next time.